Ready to start your ESG journey? Get going today with Social Suite, and you could start reporting publicly in 30 days. With investor pressure mounting and regulations just around the corner, there's never been a better time to start your ESG reporting. Social Suite takes the complexity out of environmental, social, and governance reporting. Social Suite helps organizations to measure, monitor, and report on their progress with fast, simple, and affordable software. Create value through ESG in order to raise capital, improve brand and reputation, as well as mitigate risk. Social Suite has helped almost 100 micro to small cap companies report on ESG, with some starting their baseline report in under 60 minutes and reporting publicly within 30 days. ESG is a lot easier than you think, and you're probably already doing it. So take your sustainability reporting to the next level with measurable progress. Start your ESG journey today with Social Suite, an ESG software company for micro to small caps. Visit socialsuitehq.com. That's social, SUITEHQ.com to learn more. This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make any investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast. My guest on the show today is Daren Trousdell, Chairman and CEO of NowVertical Group. It's a publicly traded company. The symbol is NOW on the TSX Venture. Now is a vertical intelligence VI software and solutions company growing organically and through acquisition. Now's VI solutions are organized by industry vertical and are built upon a foundational set of data technologies that fuse, secure, and mobilize data in a transformative and compliant way. The Now product suite enables the creation of high-value VI solutions that are predictive in nature and drive automation specific to each high-value industry vertical. Periodically, I crowdsource what companies you'd like to hear me interview on here, and NowVertical came up a few times, and they also are a constituent in the Planet MicroCap Index this quarter. With all that said, I invited Daren on the show to discuss NowVertical's acquisition strategy and criteria, vertical intelligence, what this means, and suite of software and solutions available to their target customer base, as well as who their target customer base is, and the path to profitability and balancing that goal with growing at the pace that they foresee. With that, please enjoy my conversation with Daren Trousdell, Chairman and CEO of NowVertical Group. Daren, thank you for joining me today. How are you doing, man?
I'm doing well, and thanks for having me.
It's great to have you on. So, NowVertical has been on my radar a little bit. I think it was either the last quarter or the quarter before where you qualified to be in the Planet MicroCap Index. I've had I always try and crowdsource to see who, I should potentially have on the show. NowVertical was recommended by a few folks. So I'm going to do my best to make them happy and give them the full picture here. So again, thanks again for doing this. And to start us off, it's my first question I ask everybody on here. What would you say is that one line that best describes NowVertical?
We are building the vertical intelligent future, helping our customers have the confidence to make bold data-backed decisions.
Very good. All right. That gives us a lot to dig into here. So give us a little history. When did the company start? What was the original thesis? Take me back to where you got started and how you got to where you're at today.
So I was involved with the company in 2017 timeframe called Signifier, which I thought was a super cool company. Their product that they were very successful with kind of out of the gates was a data fusion platform, which in English means they took data from their customers, whether it be structured data, so spreadsheets, emails, basic structured data forms, and they fused it with unstructured data, audio, video, scanned documents, so that their customers could have their data in one unified data model, so that they can view, analyze, work with the data in one place, which is super important if you're doing any kind of meaningful analytics. And They were successful. I really liked the pedigree of the company, ex-military. Long story short, it was a great technical company, great technical team. Some things left to be desired on the business. There was problems with the company in terms of its direction, future on the business. I saw an opportunity, worked with the board, bought the company, and in a private setting, it was okay. Now we have the software company. What are we going to do? And the idea was sparked that in this industry in big data, there hasn't been a scale competitor created to the names like Palantir, C3.ai, Alteryx in the markets, especially in the public markets. And the way to do it, in our opinion, was to build a consolidation model. Can we roll up big data companies very quickly, very efficiently to build the next large scale competitor? And that was the vision. We started it, we took it public in early 21. It started trading July of 21. And in that time frame, we added a couple more acquisitions. And up to today, there's been 9 total acquisitions. There's 3 more in LOI that we're wrapping up. We're going to stay acquisitive for the foreseeable future, but it also has an organic element to the story now that we can talk about as well.
Absolutely. Well, to first on the strategy itself, I mean, were you seeing an opportunity where there's a lot of these companies that were now, quote unquote, I don't want to say available for sale, but you saw that there was kind of okay, we're seeing the big picture. We have our core technology. Are there any other quality big data companies out there that might be selling at a discount, or maybe family run businesses that are just looking to kind of, get an exit? And now we have this core technology. What was the strategy there?
Big data is actually a very mature market. There's been many software products, many experts, data science experts, data analytics experts that have been in the market for years. So there is thousands and thousands of companies globally, right, that are doing different things. What we saw as the opportunity for the impetus of the strategy and the roll up was there are so many subscale companies, and this is a general issue in software. There's just so many subscale software companies that aren't going to make it in terms of becoming, big on their own. And we're seeing now in the markets what happens when you get on the, venture capital multi-round mainline. It doesn't always end well. And the valuation thresholds and ladders need to keep going. And that ultimately creates a dilutive situation for founders where it's frankly not worth it. So there's a lot of smart people in our industry. We're a very, very advanced industry in terms of pedigree. It's not discretionary tech. It's very mission critical technology and service. So that was the foundation of it. We saw that with our first acquisition, Signify. We just saw how important the product and the tooling is in the market, and the subscale aspect, meaning they're not going to be able to get over a revenue threshold on their own. So those are kind of like, when you're putting the building blocks together, the perfect pieces or the perfect storm for a good roll-up strategy.
Absolutely. So, let's talk about what's currently in the portfolio right now, and then we'll get into that criteria a little bit more, as well as, the companies itself. So tell us about the portfolio itself.
So the portfolio now is 9 companies with 2 distinct elements of our business. One, which is where we started, which is software. So our software platform today covers everything from data governance, security, mobilization with Fusion, and we have a couple different analytics products / data science products. That's basically the software portfolio today has our customers end to end, making their data available, compliant, secure, and being able to use it. And we have a long way to go to keep adding to that, tooling, and we're going to continue to do that because it's also a vertically specialized industry. So, automotive versus government versus oil and gas is completely different need set. And then the other side of our company is a very powerful global service offering. So when I mention the vertical specialty, you need experts to implement the software and operate the software, or train our customers to operate the software. There is no one size fits all in our industry. There are many companies that present it that way, but it doesn't work. Any kind of meaningful large enterprise sale in our industry has to have an element of managed services. So we've been buying both types of companies. We buy a software product, but we'll also buy a regionalized or a global expert service group that will come in and provide that level of service, but also we get the customer portfolio out of it too. So now there's over 200 customers doing advanced work in their industry. And the idea is we have our software products sold in through our service groups as well to accelerate the sale. That's the model.
Got it. And what was your criteria for the 9 acquisitions? Did you kind of go in and like, all right, here we go. Like, let's take a look around and see what's going on. Or did you come in with already a disciplined approach as like, okay, this is what we need to hone in on?
Going over to the kind of corporate business, investor side, we do
the more fun side. Come on, man,
Yeah, we have a very defined profile. On software, it's a little more difficult. Most of these subscale software companies are losing money or they're break even. They have explosive growth or they have moderate growth, is what we've seen. The criteria for us is if they're not profitable, we can make them profitable. We have a unique model in software, how we operate our software businesses. We actually try to reduce human overhead in our software businesses, which is, obviously the opposite of how software businesses are run and how they've been running, right? And, now you're seeing nothing prescient from me, but you're seeing what's happening in the market where, 13% of a company can get wiped out in one day today, with Meta. For us, we want that done day one. We want that done. We buy a company, we already know the playbook, and what we've been able to do, we have a great case study in one of our acquisitions, which is Affinio. A cool company. They had venture capital backed. We bought it. It was an accretive deal in the deal context, but it was a typical software company. They had some moderate growth, so we saw opportunities to grow revenue, but they didn't have a profitable profile ever in their history. And we set out on a mission to completely transform their cost base, and we did. And people from the founding team, it's not going to work. We've thought about this, we've done this, and you just rip the Band-Aid off, and now we have this thing north of 30% EBITDA margins, on a standalone basis, and it's growing. That was the funniest part. We got it. We increased its growth with less. So criteria for us software that's very specific. Criteria on our services business, it's very, very simple. Services businesses, for the most part, unless they're horribly run, are profitable businesses, spin off cash. We are buying services businesses as fast and as aggressively as we can, because it gives us global footprint. So our customers now have a supplier in NowVertical that have Latin American, UK, EMEA, North America covered, and we're building on that. The criteria for us is those companies have to have a history of profitability, history of client retention. What's unique in our services business is we're not project-based. Every customer is some kind of longer-term managed service contract in our industry. So, over 75, 80% of our revenue is recurring in nature. So that's kind of altogether nice. So those are the criteria elements. One thing I'll add that we do, so I talked about the optimization of the cost base and software. Generally, on our services, our software business has 75-80% gross margins like normal software businesses. Our services businesses have lower gross margins, so we work tirelessly to optimize those so that ultimately the future for us, 23 and beyond, we can get a better gross margin profile closer to 60%.
Social Suite takes the complexity out of environmental, social, and governance, or ESG reporting. Social Suite helps organizations to measure, monitor, and report on their progress to create value through ESG in order to raise capital, improve brand and reputation, as well as mitigate risk. Social Suite's software platform makes ESG reporting fast, simple, and affordable. Companies can start building a baseline report in under 60 minutes and start reporting publicly within 30 days. Start your ESG journey today. Visit socialsuitehq.com. That's social, suitehq.com to learn more. It's an interesting, this story is kind of interesting, right? In the sense that, I can imagine when you guys first became public, telling this to new investors was like, wait, okay, all right, it's consolidation, big data. You got the software side, you got the services side. I mean, how has the experience been? I usually say this question for the end, but I might as well bring it up now. How has the experience been being public company CEO and having to explain this story to investors right now?
I think it was hard early because our challenge is we buy a company, the deal closes on date X. By the time that is, in your financials, it's lagging, so they can't see it. So Q2 came out and it was like, bing, the numbers were like it was like 900% or 800% higher than the previous quarter. So investors were like, oh, I get it. Like I get it now. Like I see how this makes sense. What we're trying to articulate in the financials too is there's two reporting segments. There's our software reporting segment and our service reporting segment. And now the service reporting segment is a much larger business than software, but over time, software, as we acquire more software companies, will moderate, and it'll drive the gross margins up, and obviously the total group EBITDA margins. The financials are what investors understand in our business. Do they understand predictive and prescriptive analytics and some of the advanced tooling we have and the industry specific thinking? Some do, some don't. I think on the institutional side, they really understand our business. But we're a micro cap, so institutional is not always easy, especially in terrible markets. So retail has really latched on to a couple things. One, the Canadian market understands really strong roll-ups. They do. A couple, with Constellation as our granddaddy.
Absolutely. Yep.
And CTS, is another great success story in the market. We are such a different product though, because we're an enterprise sale. Like, we have some contracts that are, multi-million dollars. We have a north of $75-80 million backlog right now in our government business alone. There's real meaty stuff in here, and we're just kind of playing in microcap land until this thing turns, and that's coming soon.
Right. So another question that I have for you as well, when of all the acquisitions you've done so far, and clearly there was a reason that you did each of those deals, otherwise you wouldn't have done them. To date, what's been the thing that investors, or even with internally, that you've been not necessarily surprised, but the performance has really been higher than expectations, and then also vice versa, maybe one that's still kind of a slower climb?
Yeah, so we bought a business. That's a great question. We bought a business in Latin America, an Argentinian-based business, and it's a great story because I just cold called this guy, and I'm like, I'm looking. I don't know why, but I was just like, I knew Latin America was a market we had to be strong in, and I cold called him, and he was going to be in Miami the same week, and I'm like, come meet me for a coffee, and it was a very funny coffee because he was nervous with his English, and I don't have any Spanish capability, so it was kind of a fun talk, but I got the sense from him immediately their capability set, and it was so strong. Like we were just getting into the tech and the tooling, and it was very, very impressive. This business we bought called Core BI has grown itself from nothing. I think last year 6 and it changed 7 million. This year, we're going to be 30-40% growth on that. It's just exploding in the market. We opened an office in Mexico. So that was like a business we bought that we didn't have to do anything. We had great leadership. We don't have to cut checks so that we can spark something in the market. They have the market, and we're doing other stuff like Latin America. I think for us, we've got a lot of activity there right now and some new things. We're going to be a top player. Like it's in terms of revenue and market share against the Accentures, the big guys. So that's a really special deal. Like I think one for my notes of acquisitions in my past. I've done this in a lot of different industries, and this one is special. In terms of things that are slower or more work, I look at it more of the heavy lift. everything we've done has been successful in our model. So we haven't had a blow up or a failure. What what's been slower on the software side is really getting the organic engine fired up. And we got to remind ourselves, we've literally only been doing this from the beginning for 2 years. We just crossed 2 years. The thing's going to exit 21 at 40 million USD on a pro forma run rate. That's unbelievable. So sometimes when we're like, we're not moving, like, we are moving fast. So one thing that, we are really trying to do for 23 is have our service group. So take this Latin American success story, really make them inspired and give them the incentives to move the software through the customer. And that's the organic growth driver. That's the value unlock right there. We do that. Our normal 20% growth could be 50, could be 100. It could be outsized. And the margins on software, 80% gross margins. We get these things doing 30-40% EBITDA margins. It just hits the bottom line, and it's completely transformative.
Absolutely. What would you say are some of the tailwinds that are helping you justify some of your reasons why you're seeing some of the growth that you're hoping to see in the company?
It's a great question too, because I say this a lot, and I don't know if this resonates with the investor crowd or not, but like I look at tech in a couple different ways. I think general SaaS products right now are going to have a lot of headwinds, and the headwinds are because they're discretionary. I've got my SaaS portfolio. I have a graphic design package. I've got this little tool. I've got this customer list tool. I've got this sales enhancement tool. Those are discretionary. Our product and our service are mission critical. When we deliver our Reveal product or privacy product in market, that is fully embedded and integrated into our customers' data estate. It is very, very difficult to just unwind what we do, find another product off the shelf, and start, rinse, repeat. Fusion for us, it's integrated across all of GM's enterprise. Like, it's just difficult. And the investment so far on that product alone, that's like a north of $60 million investment over the last few years. So it's very difficult in our industry to just, rip, strip, fit, move on from what we do. And just that's why I love this business so much. This is very, very mission critical stuff, and it's not discretionary. And that's why I think it's a very durable model, and why I'm going very, very hard into this specific space.
For sure. And you mentioned how your background, not totally. I mean, you came in the business or for Signifier back in, I think you said 2017, right?
Yeah.
What was your background prior to that? And they gave you the confidence, like, all right, roll the sleeves up. I could take on a roll up. Like, let's do this.
Yeah. So I'm a founder entrepreneur. I've been in technology my entire career. I started a very successful digital marketing agency in Canada that was one of the biggest ones, which was bought by a group called Aegis Media. Aegis Media was one of the largest advertising holding companies, mostly on the media side. While at Aegis, I got exposed, obviously, and connected into the M&A program. I took over a North American portfolio. We did about 50 transactions during that time frame. I got the bug. I did my own deal, and then we started doing other deals. Deal values of $500 million to $500 million. It was and what I realized there was it wasn't rocket science to from a capital markets perspective to operate that. So then after I left, I started just doing, making investments, working in different projects, more on the tech kind of startup side. And I was just not satisfied with the model. Like, I was just not getting any returns that outsized returns that I wanted to see. And the only returns I've ever made that were meaningful were doing my own thing. And that's why this resonated with us. And then it was fortuitous that Signifier kind of fell in our lap like that. But at the same time, it's what sparked the idea for this. I needed that project. I wasn't like a lifer in this industry. It was the right time, right place, right moment, right everything to do this.
Absolutely. So now getting to another corporate type question, your favorite, you love the corporate
I do.
type question. No, I'm just giving you. From a competitive landscape, what does it look like out there? Is it specific to each company within the portfolio, or when you think about it in terms, is it more, one to one with NowVertical versus others? What does it look like?
No, it's still very from a day-to-day competitive landscape. It's very still connected to the portfolios because we haven't done a full brand migration yet, which is coming. So that'll change in 23. But we from the actual business perspective, there's lots of competitors, right? There's big companies, Accenture, IBM, all these different major guys, and we're usually a challenger brand. um, the regional expertise helps us, and on the software side, we have a unique product, and that all our products end up working together really well. So we have a comprehensive platform that even some of the biggest companies don't have, and capabilities. So that helps us there. On the capital market side, we don't really have a micro small cap competitor for in this space. We're it. And what we do though is we have aspirational competitors in the capital markets like Palantir, Alteryx, C3.ai, where we don't see that we're that far off. Like our program right now, we've brought together, booked, this 40 million USD pro forma. We have 3 more acquisitions on route if all goes to plan. That's another 30 plus. That'll be 70 plus million. And our real goal this fiscal, which will hopefully get done or early Q1, was to get to 100 million top line. And the reason that was so important was this aspirational competitive set. C3.ai will do just over a couple 100 million revenue. Like they've been doing this since 2009. We can roll in over 100 with our organic growth rate, have a forward revenue number of 120, 130 plus new acquisitions. We can be there next year. And then we're in the arena with the message that we want, and that's where we want to get to.
Absolutely. So, I mean, a quick follow up on that. I mean, in terms of ramping up the speed at which you're doing some of these acquisitions and bringing more companies in the portfolio, is it as fast as you can to get to that 100 million top line, or it still has to be the right deal?
It has to be the right deal, or and
Sure.
I've seen this all the time. You have a software company buying a cannabis company. You can do stupid stuff in this model and it doesn't work, and it's like hard lessons that I don't know why people don't learn. We have to do the right thing, but I'm just telling my team, you got to do the right thing and you got to do it fast because we're in a race here, and because we're not going to be the only guys out there that have this light bulb go off, and at some point when these other aspirational competitors start hitting a growth wall, they're going to have to think about M&A. And then it's just creating more competition for us. So let's move as fast as we can, get to real scale, and then we'll have a different product in the M&A world.
Absolutely. So then, what are some of the sample deal structures? Because I'm sure the folks that, you're looking to acquire, correct me if I'm wrong, understand that, hey, it might be this race soon to gobble them up. So what does the deal structures kind of look like, and how do you work with the potential acquisition on, like, hey, this is the opportunity with us versus maybe some of the other big players that are now looking at them?
So we have not really encountered a competitive situation for the size of company we're buying yet. I think the current market is giving us extreme tailwinds right now and giving us an unparalleled opportunity. And I've been talking about this for over a year, which is on the software side, you have companies that have been waving their flag 10, 15 times forward revenue. This is wonderful. The data's out now, and these companies are getting 2.5 times on software. On the services side, we've always got value in services. Services are not they're not being sold for extreme multiples. They're being sold for 4-6 times EBITDA multiples year over year, very consistent. Some of the hotter, flashier shops will get a little bit more, but those deals we do all day long. But on both sides, our typical deal structure is pretty simple. We give some cash up front on value for the business, 3-year earnout for based on their profitability targets, EBITDA targets over a 3-year period. We have a unique model that we've employed that I used to use and I've been using in my whole career now, which is creating a floor. So the floor on the earnout, so call it, let's say 23 calendar year, your target's $1 million. We have a floor of $1 million, below $1 million. We call it a floor of 800, below 800,000. We'll keep it. Over 800,000, you start earning to the cap, and then anything at the cap or above, we start sharing. So that's how we do it. So it's a win-win. And the idea here is we bring cash back to corporate, reinvest the cash in the next deal. Obviously, that'll happen at scale when there's enough cash generated, and that's a very consistent, tried and true model. We just need to keep the engine going to get to meaningful cash.
Absolutely. That actually hits on my next question, because clearly, you guys are in a hyper growth phase where you're trying to get to, where you previously just said, get that 100 million top line. How do you balance the growth objectives for NowVertical versus the path to profitability, right? Love to hear your thoughts there.
So it's a very tough balance, because you want to invest, but at the same time, we're buying operating companies that have history of earnings. We want to leverage those earnings in our company, at least now, to neutralize any losses. And that's project one. So growth of 100 was the goal. Project wise, neutralizing losses is on an adjusted EBITDA basis was project one. So Q3, what I've messaged to the market is we'll be pretty close to a neutral adjusted EBITDA, which is going to be nice. First time we've ever been close to that. And then Q4, it'll show up. We'll show our first positive adjusted EBITDA quarter, and then that's the fuel, I think, that's going to get this thing really moving, because the next set of deals after that's doing is just increasing the profitability profile, free cash flow generation next year, reinvest cash, rinse, repeat. That's the model.
Very good. Another, devil's advocate type question I got to ask. I ask everybody on it. In your opinion, what would you say that are some of the company's downside risks that, I guess the headwinds in some cases that could go against NowVertical in accomplishing some of your goals?
It's a very good question, a very important question. We have never had our stock appreciate ever since we went public, and then, when we're in a comp set, I guess, in the Canadian public markets, where there's all of these pumpy names that have, all this activity and all this capital going into them, and they don't have a business. So it's very frustrating to us, and I'm sure to some of our shareholders, as I'm the largest shareholder in the whole company. So, I'm sure if it's frustrating to me, it's frustrating to them. But like that to me, we have to get the stock moving, because we have traded paper in these deals, and these deals have got to pay off for the sellers, and we need to value in the stock, and that's a long game. So, you got to have patience, and you got to do what we do, and it'll take care of itself. But like, that's one thing, we have to get the stock to start paying off, because then, we want to manage dilution. Second kind of downside, is obviously a macro environment in the capital markets. You just get apathy, or they're moving to a different sector. You're sitting there kind of in purgatory on, raising capital for deals or for specific purposes. Not a good place to be sometimes. I think we're lucky because of the deals we're doing. They're profitable, they're accretive. We don't face that, but I don't think we're immune from these things either in the bigger sense. So I look at the kind of stuff we can't control as the downside. I think the business on the operation side, I'm just feeling super strong about what I'm seeing in the business. Like, we're not having contracts canceled because there's a looming recession. Like, again, we're mission critical product. So I feel strong that, because if you don't do what some of our products do, you get fines, you can go to jail in certain jurisdictions. If you're like having your data exposed, you're, improperly using it, there's a lot of risk here that regardless if you're laying people off or not, you still got to pay money for it.
Absolutely. I also have to ask, it's, you have portfolio companies are based all over the globe, right? You're based in Florida. Why'd you go public? Why'd you go public on TSX?
Well, I'm a Canadian, but just
Canadian, you know what I'm saying. TSX-V. Sorry, I apologize.
no, it's it is at the time too. Like it's a very efficient process in Canada. It's a lower cost jurisdiction versus going public in the US. And while you're building in the smaller micro sense, it's a more receptive market than the US markets, which I think is important for an early stage. That said, it does, you do reach a limit in Canada versus your investor exposure. So you'll see some news from us and in the future of some things we're doing in the US to get better exposure and make it easier for US investors to be part of the story. This is a very US centric story. Like that's, it's the company's main kind of heartbeat was US based, in terms of our founding companies, but it's a global company now. Latin America, multiple acquisitions in UK and Europe. So, it's a global company at this stage. So it's really, and a fully distributed company. So whether I'm in Florida or Toronto or wherever, like it's wherever anyone is.
For sure. All right. So my next question then for you, from what you can tell us, and of course, in your opinion, and you mentioned this already a little bit, but maybe we'll get the full picture, is where do you want to see the company in 3 to 5 years? What's your vision for it? And then what would you say are the inflection points that'll get you there?
So getting to 100 million was kind of job one. It's not even an if we can get there. We know how to get there. So once we're there, we see a 3-year picture of a $500 million revenue business quite comfortably. And I think our deal size will go up substantially after the 100 million mark, because I think our capital markets exposure will be better. I think it'll be a better story for institutional. I think that fuel will allow us to take some bigger bites in the market with some bigger companies. So 3 years there, 5 years, I really think this is a multi-billion, well over $1 billion revenue business. And our aspirational competitor, Palantir, has crossed $1 billion of revenue. And, that took 15 plus years. We think 5 years we can do this. And at that point, it's, market giving us adequate appreciation. It's a large story.
So Daren, to close us out here today, as you mentioned, the company hasn't been public for very long. You talked about your experience already being public company CEO, some of the joys and also frustrations right now. How's been the experience in working with some of your shareholder base as well? Have any of your has it affected any of your decision-making process, or how do you envision that even also moving forward?
So I'm pretty active with our shareholder base, whether it be large shareholders on a one-to-one basis. I'm in Discord groups with our shareholders, and I moderate the discussion when they're sharing information so it's accurate and it's relevant. I've made it a point in this company, because of the way the structure of our company. It's an investor-led company. It's almost just under 50% insider held. So we're in the arena with our shareholders here. This is not management versus shareholders. So highly interactive, highly interactive. I get direct messages from shareholders asking me very benign questions, and I'll answer them. I'm making it a point, and maybe it's even a little experiment here, but I'm making it a point to be very, very communicative and build relationships with any investor that wants to talk to me.
Very cool. All right. I think we're pretty much there, Daren. So, with that, where can our audience go and find more information on NowVertical?
Very simple. Go to NOW.vertical.com, or in your, terminals charting, NOW.V on the TSX-V, and, learn more about the company, set up time with management, ask questions, get in the Discord groups, what have you. I'm at your service.
Awesome. Daren, thank you so much for joining me today, man. I really do appreciate it. Good luck. Stay safe. I look forward to our next update.
You too. Cheers. Take care.
This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make any investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast.